A very good evening, ladies and gentlemen. Welcome to our webinar this evening. Tonight's topic will be spilling the tea on the US markets. So what are we covering this evening? Three things. We'll break down what you need to know on the world's largest stock market, that's the US market, the historical performance and why staying invested is key, and what are the biggest winners and innovations means for the stock market gains. So to give everyone a brief outline, we had our media launch earlier, a couple of weeks ago on ProsperUS. What's ProsperUS? ProsperUS is a new full-fledged digital service created from millennials by millennials. So there's a QR code at the bottom of the screen. Do scan it and visit prosperus.asia for more content. So tonight, my name is Ernest, the Director of Client Success. I'm also the Head of Digital Business. So basically, I have Tim Phillips, our content composer, also known as our head of content, will be joining us tonight. He will be sharing his investing tips as well as what are the markets, what are the stocks that we are going to share this evening. So Tim has over 10 years of experience in the Motley Fool, being the last one, and in Schroders. So tonight we will hear more from Tim. So we have a few upcoming sessions this time around in the next 2 months in April and May. With April, dispelling the US markets myth, and in May we have to teach you how to build your own portfolio. So stay tuned, sign up and register now, so don't miss out on the next 2 webinars. Also, what's special about ProsperUS this time around? We created this thing called the ProsperUS Club. We have 3 E's that I want to share with you and take away on this journey with us. Firstly, we have the engagement piece. We definitely do have our formal channels of engagement with our members or our clients via your emails as well as the voice calls if you need any account-related matters. So we are here. We also have our social media engagements via the Facebook, Instagram, as well as LinkedIn, or even TikTok and Telegram. So sign up and stay tuned to the latest updates that we have on behind the scenes, via the stories, or even the latest updates on latest stock picks. So on the education piece, the second E is that TMS tonight is one of our key opinion leaders. He will be sharing with you the investing knowledge as well as the key, as being a key opinion leader, he will also be sharing with you simple tips of what are the S&P 500 and also what are the different stocks that you may be interested in. So you ask us any questions at any point of time at the chat box below. So we also have investment insights and monthly quiz, at our webinar. So if you answer something correct, you might gain a special gift from us. We also have the different experiences that we curate for our members this time around that ranges from dining to wellness and lifestyle experience that I'll be sharing more with you later. And these experiences are curated by the millennial team behind the ProsperUS team. And every of them are different in every quarter or every 6 months. So this time around, we have the first campaign that we launched is called the Invest and Experience. You can gain up to 880 worth of commission rebates from all the 8 asset classes that we do offer over the period from 1st of April to 30th of June. If you fund your account from 10,000 onwards, you will get to receive these curated lifestyle experiences that I'll be sharing more with you. So what's in it for everyone this time around? We have 3 segments that we wanted to share on lifestyle, wellness, as dining. So we partner with local establishments or even SMEs to bring to you curated content and curated activities. So we have on the lifestyle like wood crafting and wheel throwing activities with partners like Tumba Lake or even Terra and Amber, or even something that is more interesting like flotation therapy, floating in the very therapeutic system that you can try. I bet many of you have not even tried it before, or even something like ground zero fitness, spinning in a loud music and at a different type of cold climate, something very interesting. Or last but not least, dining in a afternoon tea or an array of martini tasting at a very famous Atlas bar. So what are you waiting for? Tonight, what's very important for all of us to note is that we definitely have Grab Away Thank you, Zoe. So to open an account with us, do scan on the QR code. On board with us, we have a 15-minute, 20 minutes digital onboarding. Key in the promo code T for all. And if you fund your account, you start investing, you will also get, on top of the $880 of commission free, you also get the $20 Grab vouchers. So we only have 30 participants who will get walk away with it. So first come, first serve. So stay tuned to it. So do follow us on our social media sites that you see on our LinkedIn, our Facebook, as well as on Instagram, and our Telegram channels that we share Tim's updated content, or even our promotions, or even follow our ProsperUS website on the right. So stay tuned. Without further ado, I would like to bring Tim into the picture and share with us more about the US markets this evening. Over to you, Tim.
Thanks, Ernest. Thank you for joining us, everybody. Appreciate you giving your time. So I'm going to try and keep this short and sweet. I am going to kind of run through why we should be investing in US stocks, what the best options are to approach the market, and then also maybe something a bit more about the global, as it is a global marketplace, because it's not well known that the US is actually a market that has international stocks listed on it as well. So it's not just US stocks. So without further ado, I will start the sharing. Okay, so let me begin. So I'm going to spill the tea on the US market, and hopefully you guys can learn a little bit more about what the goss is on the US market, what is going on, what's the lowdown with the US stock market, and hopefully you'll come out a bit more wise with after this webinar. So the obligatory disclaimer here: this is my own personal opinion. I am not giving personalized financial advice, so my compliance team requires me to do this, so I'm going to keep them happy. So just keep that in mind. So let's start. Okay, so why the US stock market? I think this is more of a refresher. I'd actually covered this a few weeks ago on the first webinar, but I just wanted to go over it again just to make sure that we are all on the same page about how big the US stock market actually is and how much breadth and depth it actually has. So if you look at the US stock market as a whole, there is if you take all the shares that are listed on the US market and add it together in terms of its value, it's actually worth $45 trillion. So if you think about that number and put it next to the local stock market in Singapore, where we have the SGX, the total value of the Singapore stock market is just around 550. It might be about 600 billion. These numbers might be a few weeks old, but it's basically a fraction of the US market. So if you're looking at the US, it's just way ahead of any other market. I think China and Hong Kong is around 7 or 8 trillion, and then China, probably maybe above 10 trillion. But the US is just way out there just because of the depth of its market and the opportunities for people to access it as well. So how should we view the US stock market? Well, let's let JT kind of take that cue. It's big. It is huge. So I think first of all, we should understand the trading hours behind it. So if you're starting out buying a stock in the US, what do you need to know about the trading hours? Well, first of all, there's time difference. So in Singapore, we're 12 hours ahead. So in the US, Eastern Standard Time is what is considered the time in New York. So that's where the markets are, NASDAQ and the New York Stock Exchange. So they open at 9:30 a.m. Eastern every day, Monday to Friday. They have, I think, around 8 or 9 public holidays in the US. So they actually don't have that many holidays in the US. So markets are open most of the year, actually, in the US, and it closes at 4 p.m. So there is one thing to remember about the time difference, is that when there's daylight savings, it is 12 hours, but when it goes, when the clocks go back in sort of October time every year, there's 13 hours time difference between Singapore and the East Coast of the US. So it becomes a 10:30 p.m. open in Singapore and a 5 p.m. close, whereas obviously now it's a 9:30 p.m. open and a 4 a.m. close for Singapore. And then there is pre-market trading, which allows people to buy actually before the market opens. And then there's also after hours trading. So after hours, it allows you to trade maybe an hour after the market closes, and pre-market allows you to trade maybe an hour or 2 hours before the market opens. But not many people do that because the liquidity in the market is quite low at that point, which means that you're constrained in the amount of in the price movement that you can, the prices that you can get. You can't get a good price for the stock because the spread between the bid and the ask will be quite wide. So generally, as long-term investors, I advise us not to do that. So it's generally something that maybe more professional traders might partake in. But if you're starting to invest for the long term, just buying a stock and holding it during opening hours is completely fine. So as I said, yeah, don't bother staying up. There's not much point. So I just took an example here of Zoom. So this was actually Zoom's movement in August, at the end of August last year. So they had just announced results. And most companies, when they do announce results, they either announce results before the market opens or they announce results after the market closes. So the reaction to the share price actually happens in the after hours and pre-market trading. But to think that you can get in ahead of it and sort of buy at a good price is, it's a fallacy. It's really, really difficult to achieve. So actually just buying and holding allows you to ride on these kinds of price spikes when they happen after hours or pre-market. So as you can see, they blew away expectations, Zoom as a business for I think their third quarter. And the stock reacted, right? It went up 24% in after hours trading. And so the next day when it did open, it opened up about 24% at the open. So you can see that day trading isn't going to be rewarding you over the long term. It's more buy and hold and just buying great businesses, holding them, and letting that compounding happen, because the compounding or the price action, a lot of it actually happens in sort of out of trading hours. So I think that's something we should remember about long-term investing. Okay, so I'm going to move on to big winners in innovation. I mean, we all want to hear about tech, right? Tech's huge, tech's big. It's the next big thing. They have the world's largest companies or technology. So I think this is the area that really excites us because it's got the most potential for us to grow our money, which is fair. It does. So a few weeks ago, I'd spoken about the S&P 500 in the US, which is the go-to benchmark of the US stock market because it has the 500 biggest companies in the US by market cap. But this week, I'm going to focus a bit more on technology because I know for most investors who are investing, nowadays, I think the technology scene in the US is really exciting, and that's definitely true for the next decade, I think, and beyond. So the NASDAQ 100 probably encapsulates this technology craze the best. It was founded in 71. NASDAQ 100 is actually a benchmark that provides 100 of the biggest technology stocks that are listed on the NASDAQ. But you also have a lot of different stocks, non-tech stocks that are also listed, including sort of Starbucks there, exactly, Costco and Heinz. And I think it's really the go-to if you believe in investing in tech. And as you can see over the past sort of 20 odd years, after the crash, it managed to completely sort of crush the S&P 500 and the Dow Jones both because of just the phenomenal growth rates of the big tech giants. So if you think about Amazon, Microsoft, Facebook, Google, Apple, and Tesla, which are the 6 largest companies listed in the US by market capitalization, they're all listed on the NASDAQ exchange. So that allows them to sort of, the NASDAQ 100 really has been driven by these tech giants over the past 20 odd years. So if you do believe in the power of tech, I think it's wise to invest in an ETF. Maybe if you're starting out investing if you like technology and you're bullish on tech, invest in an ETF that tracks the NASDAQ 100. And I think the most well-known one is the Invesco NASDAQ ETF, which is under the ticker QQQ. So that's the one that's the default for people who want to invest in the technology sector in the US.
Thank you, Tim. Can I ask, what's the main difference between the 3 key markets that you actually mentioned, being NASDAQ, Dow Jones, as well as the S&P 500? We do know that you had covered the S&P 500 previously, right? And that's the first question, what's the main difference? And the second question is, which of it, because of the composition of the stocks in each of these markets, in your opinion, which would be the one better for general retail investors, especially when we want to talk about ETFs as a basket of goods or counters?
I think if you're thinking about broad exposure, the S&P 500 is better. It's clearly the better one just because it has 500 components in the index, and it also has less of a technology exposure, obviously. So I think in the S&P 500, there's probably about 20 to 25% is made up of the big tech giants, whereas in the NASDAQ 100, obviously the weighting is mostly tech. And the Dow Jones is actually more of a relic. It's not really used by professional investors anymore because it's so narrow. It's only got 30 stocks, 30 companies, and there aren't that many really powerful tech companies in the Dow Jones. So it's less of a accurate reflection of the US business outlook and business composition. So I'd say if you want broad exposure S&P 500, if you're bullish on tech, obviously the NASDAQ 100 is the one to track.
Okay, thank you. I think before we go on to the next slide, I think there is one person who is asking, when people refer to the NASDAQ closing, is it a NASDAQ or is it NASDAQ 100?
Oh, it's the NASDAQ, because the NASDAQ is just the stock exchange. The NASDAQ 100 is a benchmark which has 100 components. So the NASDAQ 100 and the S&P 500 are benchmarks, and then the NASDAQ exchange and the New York Stock Exchange are stock exchanges where the trading takes place. So the NASDAQ 100 is basically just a benchmark that tracks performance of 100 of the biggest stocks on NASDAQ. Yeah.
Yep. Okay. I think we have no more questions. I think we can proceed to the next one.
Cool.
Yeah.
Okay. So innovation, it tends to produce winners, right? So if you're thinking about growing your wealth, you want to be investing into innovation and the winners behind that innovation, because they tend to compound over time. And as you can see, technology here, I've just taken data from the past sort of 13, 14 years, annual returns of specific sectors in the S&P 500. And on that basis, they've broken it down. Generally professional investors use the MSCI sector breakdown, which has, I think, is about 10 sectors here. And a couple of them are a bit newer. So real estate's a bit of a newer addition from 2012. And comm services actually used to be telecoms. So technology, you can see, has some of the best returns over the long run from 2007. And I highlighted healthcare as well, because healthcare is one of those that we don't really concentrate all that much on, maybe because we're obsessed with tech firms and SaaS stocks and high growth stocks. But healthcare is got a really big place in the returns breakdown as well, just because of how big it is and how much promise it has. And then lastly, I highlighted comm services. I mean, telecoms, you think Singtel and you think maybe like Hong Kong Telecom rather, and PCCW, but it's actually not true. It's not the Verizons or the AT&Ts in the US. The comm services includes a lot of the tech giants. So if you think of Facebook and Amazon, they actually come under the comm services, communication services subsector. So that's why you can kind of see a lot of the crazy returns, say in like last year, 2017. 2016, 15, a lot of the, and even 2019, because a lot of the big tech firms that are involved in say social media, or perhaps in Amazon's case in cloud computing, they're considered communication services. So they actually sit under that subsector rather than traditional technology. So that's something I think we should also be aware of, just from a sector breakdown. So why stocks? So I'm going to talk about why stocks, because I mean, for most people now, if we're younger, we want to focus more on equities and stocks, because that's where traditionally the returns have been. So I just wanted to illustrate that with a few charts here. I want to keep it a little moving along quickly, but it's definitely the best long-term asset class, okay? By far, as you can see. So if you'd invested $1 back in 1974, it would have turned into 160 odd by now, probably a bit higher actually, because this goes up to 2019. So it probably would be, maybe around 180. Whereas gold and a 10-year government bond, 10-year treasury bond, the total return is middling if you look at it over the long term. So for younger investors, the time horizon is our friend, right? The time that we have to invest is our friend. So if you are younger, there shouldn't really be any thought about putting a substantial amount into bonds or gold. Not to say that you shouldn't have an allocation to that, but I just don't think for younger investors, we have to think too much about putting it in. Even older investors, if you're in your late 30s, 40s, or 50s, you shouldn't be having too much of your assets in in bonds and gold just because of how much longer we're also living. So this is more about building your wealth, building it sustainably, and equities have proved to be the best place to grow that wealth. I think this is one that I wanted to also highlight just because I don't think it's as well known for people who are starting out. If you think about the best returns over the longer term, it actually tends to come from smaller stocks rather than, say, an Apple. So an Apple now, it is a great company. It's got a $2 trillion market cap, so it's humongous, and it's still growing quite well and still growing quite fast. But for Apple to reach, for Apple to double, it would have to get to 4 trillion. So that would be absolutely humongous in terms of its market cap. It's the value of the company. But if you're talking about a stock which is maybe worth a market cap of 5 billion to sort of double from 5 billion to 10 billion, it won't take as much value add in terms of the capital that needs to value generation that needs to happen. So smaller stocks, if they are really well run and they have a great market and they are they're structurally sound and they have a good story long term, they can really juice returns for younger investors because you've got the time. But obviously they will be more volatile. As you can see here, this is a chart that looks at the largest stocks in the S&P 500 and the smaller stocks over time, and how much $1 invested in just before 2000 would be worth today. And smaller stocks generally do tend to outperform. Not to say that large stocks shouldn't be in your portfolio. Again, I think that's something that you should definitely have as a foundation. But if you're looking at where your winners will come from, it's most likely that smaller stock smaller cap area. And if you're talking about small caps, that could be anywhere from maybe 300 million to over $1 billion to $2 billion US dollars in the market cap. But mid cap and large cap, mid cap could be up to 10 billion. And large cap would be over that. But if you're thinking about the Microsofts and the Amazons, I mean, they're technically called mega caps because they're just so massive. They're over $1 trillion, a lot of them, right? So they're huge, but they are very, very sturdy businesses. So I think it's something that we should just remember if we're starting out investing. If we're young, we definitely have the time to think about investing in the right winners in the right sectors. But you obviously have to be able to identify those. That's the key. And long-term investing, it does work. I'm a passionate advocate of long-term investing. I think it's something that not enough of us partake in, maybe because it's really boring. It's not as exciting as trading every day and getting in and out of the market. It is really tough work. It's a lot of patience. It takes time, but the time, if you are in the right companies or if you're in the right markets, they will reward you over time. So, I mean, obviously Tesla has rewarded shareholders over the past 10 years. And I'd like to highlight just one thing. This is not all, if you're looking at these, this is actually a list of the best performers over the past 10 years in the S&P 500. So these are S&P 500 component stocks. And it's not all technology, right? So you have, for example, Domino's there is something that's gone up 2,300% in the past 10 years. And that's essentially a pizza company. But what it's done is it's really honed in on its online strategy, and it's really cornered its market, and it's executed extremely well. So it's done an amazing job in its niche. And that's not technically obviously it's not a technology company, but you've got other companies in there such as Netflix and Amazon obviously have done really, really well. And then a couple of healthcare stocks like Dexcom and Abiomed. So there's potential for you to invest in companies outside technology that will also provide returns. But obviously technology is the most exciting. And I think one other thing to remember is if you look at Tesla, that's 14,200% in 10 years, right? If you invest, say, $100 and you lose the $100, that means you have, your capital has been eroded by $100. If you complete 100%, if you completely lose all your money, which is, unless you put it into a penny stock, is not likely to happen. So your downside is limited by 100%, effectively losing all your money. But your upside, if you look at a Tesla, if you hold it for a long term, is essentially unlimited. So your upside is not capped at 100%. Your upside is actually unlimited. And if you are in the right company, such as a Tesla, there's no saying that number, 14,200%, won't go up to 20,000% in 10 years if you had held over the past 10 years, right? So I think there's that important distinction to make as well when we think about long-term investing. And Bharat says it best. You can just buy one share in the US, right? So I think this is one huge advantage of the US market over Asian markets. I mean, I'm from Hong Kong, so I invest in the Hong Kong market, and obviously I'm invested in the Singapore market. But the one thing about the Asian markets is you have to buy in lots, which I find extremely frustrating. And I'm sure a lot of other people do as well. Whereas in the US, you can just buy one share. You don't have to buy 100, you don't have to buy 300. In Hong Kong, it varies. I know in Singapore, it's just 100. But in the US, you can buy one share of the company, and that allows us to enter the market a lot more easily as a retail investor, which I think is great. Okay, and the rise of technology. So this is something I wanted to touch on just because of how important it is to the market in the US and how clearly everyone is interested in this sector, and they should be. So I'm just taking a snapshot of the old S&P 500 top sort of stocks back in the day, or the top market cap stocks in 2000, in 2010, and you can kind of see the makeup of it. You've got Microsoft in there in 2000. It's been around for a while. You've got AIG. Remember those guys who nearly went bust in 2007, 2008. You've got ExxonMobil, which is an oil company. You've got General Electric. And even 10 years later, ExxonMobil is still the most up there as the most valuable company in the world in 2010, or in the US rather. And Apple is starting to make traction, inroads, right? 295 billion, and now it's worth 2 trillion. So it's obviously it's come on leaps and bounds. And Berkshire Hathaway is there, General Electric, Walmart. So you can kind of see it's quite a bit of an old school with a tiny bit of mix of some tech, peppered in there in 2000. And then you get to last year, and it's just dominated by technology. It's Apple, Microsoft, Amazon, as I said, Facebook, and everyone talks about Tesla being a car company, but they sell themselves as a tech company. So I think we can go with them as being a tech company. Berkshire is still there just because of its size. And then Walmart is still in there as well. But I think even a Walmart and these companies, these consumer-facing companies, everyone has to be quite tech-oriented nowadays. You have to be some sort of tech. You have to have some tech savviness, and Walmart is starting to do that. So I think everyone is in the same boat. You've got to really have some tech strategy behind your business and understanding how you can move forward with it. But this, I think, is a great illustration of just how huge technology has become over the past sort of 2 decades, and it's illustrated quite well on the top 10 table. And Simon Cowell, as he says, can take over the world. Okay, so this is something I touched on actually recently. I'd written something about this, and I just wanted to illustrate how influential US tech is in the global environment, in global business. You look at Netflix, this is from their page, just talking about where are they available in the US, or available in the world rather. So they're actually available in 190 countries, but they're actually not available in only 4 countries or regions. And I think for me, and as you can see here, it stands out, is China is one of those 4. So this is a really great illustration of just how bifurcated the tech ecosystems of China and the US have become. Outside of China, no one really uses the Kuaishous or the WeChats or the sort of Tmals, that they've kind of built within their ecosystem. But outside of the US, everyone is very familiar with Netflix. Everyone is very familiar with Zoom. Everyone is very familiar with PayPal. Everyone's familiar with Visa or MasterCard. So these types of companies have a global reach. And so I think as an investor, if you think about how these businesses scale when they start out in the US, I mean, you kind of see this a lot. And this is the perfect example with Netflix. I mean, 5 years ago, they had international revenue, I think it was around 28% of overall revenue. And then the US and Canada made up the majority of their revenue. And then you fast forward to last year in 2020, and actually international markets outside of US and Canada made up about 55%, so nearly double. Their share had nearly doubled in sort of 5 years. So it shows you the runway for growth of these businesses outside of the US, because the US is already a big market. And China is huge. Obviously, China is a massive market in itself with 1.4 billion people. But these businesses in the US, when they start to scale in the US and find success overseas, scaling quickly and finding success overseas becomes easy. Because if you think about all the best tech leaders in the world today, they're either from the US or they're from China in terms of the stock. So you don't have a tech giant coming out of Europe or South America or Africa. I mean, the odd one in maybe Southeast Asia or South America with e-commerce players, but you don't really have that stable of really, really great tech names, and they only exist either in the US or in China. So this is something I thought that was really interesting, and we should keep in mind as investors when we think about buying technology stocks. And obviously, ARK has captured everybody's imagination. It's a super exciting business run by Cathie Wood, an extraordinary long-term investor who's really bullish on just disruptive innovation and the power of technology to change the world in both investing and also in how the world functions. So I think this has really captured our imagination about thinking about investing. And the way that they've structured their ETFs is obviously focused more on the really disruptive names. But for investors who are starting out, you do have to remember that these names are highly, highly volatile. So even investing in an ARK ETF, you have to be prepared for drawdowns, or what they call drawdowns is basically the share price falling maybe 20-30% in a few weeks or a quarter. But obviously the upside is humongous over the longer term, but you have to be willing to stomach that type of volatility. And that's something that we don't really think about last year because everything's going up. So it's all great and everyone's happy. But in the first quarter of this year, when things are a bit more volatile and things are falling, that's when you kind of start to realize that it's not just a one-way street for the market going up. It can obviously reverse as well. So I think it's important to kind of keep that in mind when you do invest in these high growth companies, which are very exciting. I'm a big fan as well, but it's just you need to be prepared for that volatility emotionally, I think, which is important when we invest. Okay, so I'm going to move on to ADRs. What do they stand for? So ADRs are actually American Depository Receipts. Effectively, they are a term used for companies that are listed in the US, but have been domiciled or have their main core of business outside of the US. So it's basically global companies, and a lot of global companies are listed in the US, which maybe a lot of people aren't aware of. But if you think about Alibaba or JD.com, for example, TSMC, which is a Taiwanese chip maker, is also listed on the New York Stock Exchange. And then there's Sony as well. There's Nintendo. There's Nestle. There's all these European giants as well as Asian shares. So there's lots of companies that are actually from outside the US that list there, just because the access to the market is so big and the pools of capital that exist in the US are so large that it's really easy to raise capital, and it's really easy then to deploy that into the business. And accessing global investors is best done from US markets. And when you think about long-term, the big performers from the ADR space, Tencent's actually listed in Hong Kong, but they have a ADR on over the counter, which is not officially on an exchange, but it still trades in the US and you can buy it. So you can buy a single share of Tencent. It's just you would have to do it in the US and not in Hong Kong. These companies, again, are all a bit more techy. If you think about Tencent and TSMC and Alibaba, they're at the top three in terms of the market cap most recently. And their returns have obviously been phenomenal, especially for Tencent and TSMC and even ASML, which is a European, it's actually a Dutch company that produces that makes the machines that produce these semiconductors. But as you can see from that list, there are lots of different companies in there that you wouldn't expect, like L'Oreal or Novartis or Toyota. They all have share listings in the US, and LVMH, which is obviously the giant luxury player, that also has shares listed in the US. So if we think about globally and if we can access global opportunities, you definitely can access global opportunities in the US. You don't have to go into the Taiwanese market to buy TSMC. You don't have to go into the Japanese market to buy Toyota. There are big hurdles to get to those markets. So the best alternative, if it is available to you, is to buy that listing in the US, because you can, again, just buy one share. So that makes it super accessible. So I think we will touch on the psychology of investing. I'm just going to touch on one more lesson. I like to finish off with the psychology of investing lesson. I'm going to talk about the sunk cost trap. So what is this? This is basically thinking about, throwing good money after bad, or protecting or justifying your prior investment decisions. I think it's a good reminder that we need to be unemotional when we invest in stocks. We can't be in love with our stocks or in love with our businesses if there is something that's happened to them, which means that we may have to let go of them. That means we have to try and be detached from that decision. And obviously businesses can do well, but then they can be disrupted as well. So that's something that we all have to keep in mind when we do go into individual stocks. And it's a good reminder because for me, personally, from my own perspective, when I think about a company that has not performed to my expectations or is performed poorly below the market expectation, because it happens to everybody. For me, I prefer to take a loss on that stock and then actually use that capital and put it into something that I think will provide a better return for me over the long term. Because I know a lot of people like to leave it there. And I think I used to do that. I actually used to leave it there and think, oh, it'll turn around, it will be fine. Obviously inevitably it never does. And so I've kind of learned to think about it and to try and be more disciplined and think, oh, can I use that money and do I have a better opportunity to deploy that money somewhere else if I do sell at a loss? And usually I do have a better idea. So I think that's something we should always think about as well, sunk cost trap. There's a lot of psychology behind investing, and I want us to be cognizant of that when we think about investing longer term. Okay, so I think we're going to touch on Ernest's investing experience. Ernest, do you want to share some nuggets of your own investing experience?
That's interesting. Tim, I love your presentation. I guess I'm also equally invested in the US markets. A pure tech play. I have like what you mentioned, right? Like JD.com. I have NIO and Tesla as well as Apple. I think pretty good run of the markets, and I think the EV markets is a very strong play, in this coming months. And a lot of players, I think also Apple is going into the EVs segment. So I have a few questions for you as well, because as an investor myself, I definitely want to know, as you mentioned just now, the Netflix analogy is that at the end of the day, when you have markets that are dual listed, especially in China and US, how do you feel that the political tension between, like, now Biden has taken office, what effects does it has on dual listed counters in America?
I think the protections for investors of dual listed counters will be fine. I don't think you'll have mass delistings of Chinese companies in the US. It's just I don't think for future listings of Chinese companies, I don't think you'll have the mega blockbusters that you had of Alibaba in New York, sort of 6-7 years ago. Instead, the first port of call for future listings or big listings of Chinese companies will be Hong Kong. That's just because it's sort of transitioned away from the US. I think Chinese companies have realized the political risk with Donald Trump there. There is no predictability maybe. And so I think a lot of Chinese companies are thinking it's safer if they can raise money in Hong Kong to raise money in Hong Kong. But the companies listed in the US already that are Chinese ADRs, I think will be fine. They'll still be listed there. It's just, I think future listings, there's definitely a shift towards raising money for Chinese companies in Hong Kong and not relying so much on the US.
Yeah. Okay, so you're talking about listing, right? Do you know recently we have a Grab and an SPAC special purpose acquisition, up to US 40 billion. We are not affected by the Chinese piece, but what's your sentiments on this, and what's the difference between it with an IPO? Because I think it's very different, right?
Yeah, so a SPAC is effectively an empty shell company where, I mean, let me rewind a little bit and explain for investors who are not familiar. It's a bit more complex. It's called a special purpose acquisition corporation. I think corporation is the C, and effectively it's just a pot of money in an empty company. So they raise the money and list the company, but they've basically pre-raised the money, and then what the owners of this pot of money go out and do is they try and find a company to merge with, a company that wants to list. And it sort of speeds up the IPO process, because IPO process has a lot of underwriting fees for bankers, etc. And the pricing, isn't transparent, isn't great. But I think for SPACs, they're has been a bit of a craze recently for getting for listing SPACs or for finding SPAC partners. But when you do invest in an empty shell of a company, you have, there's no visibility over which company they're going to merge with. So I think that's the danger for a lot of the speculation that's happening with SPACs, is people are betting on this SPAC to merge with this company or this SPAC to merge with that company. And there's no guarantee that will happen, obviously. So you're effectively gambling on this happening. And even when it does happen, maybe they announce it and there's a slight pop in the share price, but then actually when they emerge, a lot of these have merged and then the share price is actually plummeted. So it's not a new vehicle. It's actually been around for maybe 10 or 20 years, but it's kind of gained traction just because of how drawn out the IPO process is. And this is a much faster route to market for a lot of companies. But I think there are some, there are some ethical concerns around SPACs and that probably need to be addressed. So I personally wouldn't, if you were starting out investing, I wouldn't be investing into any SPACs.
Okay, and I think that the last piece that I have from my own personal investing experience, right, and how to grow it before we go into the Q&A, is that, yesterday you wrote an article on Coinbase. Right. It was their opening, and they closed at high, and I think at pre-market right now, I think they are going positive up. I'm not sure what is the market doing right now, or what's your comments on that? Because I think you wrote a fantastic article on that.
Oh yeah, so that's Coinbase, right? The largest crypto exchange that went public. So I mean, I have the article on, go to ProsperUS and check it out. It's 3 reasons why I won't be buying the shares of Coinbase. So I think there is a lot of hype around. Was a lot of hype around this listing. It's actually a direct listing, so this wasn't a SPAC. So a direct listing is another complicated matter, but effectively it's not an IPO, but they just have the shares and they go straight to the market and they set their own price. So again, that is helping with cutting out fees, cutting out middlemen such as bankers, etc. And it performed quite well. Yes, I think it was up like 30% or something from its reference price. But it's a company in a new space in crypto, and I'm actually quite impartial to crypto. I don't own crypto, but I think it's definitely an exciting space, and Bitcoin's is really exciting as well. It's just I think there is no visibility on the regulatory regime and how central banks are going to regulate Bitcoin or other cryptocurrencies. So even China now has released its own digital yuan, right? So they've started to roll out a digital yuan, which you can go and buy things with using blockchain technology. And so I think that's starting to happen in the US. You're kind of starting to see these stable coins, quote unquote stable coins, which are tethered to the price of the US dollar. So it's basically linked to the fiat currency, but it's using blockchain technology. So it's a lot easier to distribute and to pay and there'll definitely be loads of uses for it, which I think is great. But with Bitcoin, people don't know where the end game is or how it will fit into a new world order in say 10, 15 years. Will it be a store of value? Will it be an exchange of currency? I probably don't think it will be with the volatility. And Coinbase is a new player. It's the biggest player, but its fees are crazy high. And so, eventually consumers, I think, will catch on and realize there are lots of other exchanges that offer lower fees to trade crypto. So there are multiple reasons I think that, it's a really hyped listing, but maybe take a step back and see how it performs for 6 months, a year, and see how the business performs before thinking about, plunging in.
Great. I think it's interesting to hear from you as well, and add on to my portfolio if I really want to buy Coinbase, opposing what you have written. Yeah. Okay. I think it's time for us to go into Q&A this evening. I think we have a couple of interesting questions. Some that are really tough.
Sure. Oh, I kind of wanted to plug our upcoming session. So for you guys who are thinking about going deeper into the U.S. market, I think there's something that we're doing on the 29th of April, dispelling U.S. market myths. A lot of people think the U.S. is just for growth, but actually there's also a dividend component to it as well, which we shouldn't dismiss out of hand. Where are the opportunities in the U.S. stock market, and then how can we best approach the U.S. market from a younger investor perspective or people who are starting out? And then second, I want to build a lit portfolio. So how do I start doing that? So I'm hoping to cover some areas where we can start building a solid portfolio of stocks. And then, there's so many questions that people have. How many stocks should you own? And then I've got a few ideas for people to sort of get going on that. So if you can, if you just do the QR code there, you can sign up for both of those. So there's one at the end of this month, and then there's one sort of towards the end of May as well. So yeah. Thanks. Sorry, Ernest, go on with the questions.
Okay, let's go on now. I think we have about 10 minutes to answer a lot of questions.
Okay, sure.
Let's go into the Q&A right now.
Yeah, let's go.
To the first one.
Go on, please.
Yep, we are waiting for the questions to be coming up. Give us a second.
Yeah, sure. Okay.
Okay, the first question, Warren Buffett says that one should not buy a stock that you do not understand. Considering the relative unfamiliarity local retail investors may have with US markets, how can one build a better grasp of the US markets? Well, it's a very, very
good question.
I
would agree, with Warren Buffett, you shouldn't be investing a lot of your money in things you don't have any idea about or don't understand. But I think for the US market, understanding the biggest names or the bigger names, if you can kind of get a grasp of the basics of maybe the tech giants and what they're doing, which I think is relatively straightforward. I mean, you've got Amazon, it's in e-commerce. We have Amazon in Singapore. People are probably familiar with that. There's also Microsoft, everyone uses Teams. There's Apple, everyone has their iPhone and their iPod. Oh, sorry, their iPad and the AirPods. So I think these are services and products that we're familiar with on an everyday basis. So I think they're quite safe places to start to understand, to grasp the market of these tech giants. And so even Warren Buffett had stayed out of tech, right? And then he went in, and now Apple and Amazon make up probably like two of the biggest positions in his public stock portfolio. So, I think even for someone like Warren Buffett, who's older, he knows a good company when he sees one, even if he doesn't fully understand all the, TikToks and crazy things and things you're doing with your phone and your selfies and all that stuff. But he can understand that this is a business that generates a lot of money and generates a lot of profits. And so I think understanding it maybe from the big tech level first, and then kind of working your way down from there and becoming more familiar with the products in the tech ecosystem, because there is a huge tech ecosystem outside of those guys as well. So that's important. But I think to answer the question, I think just becoming familiar with the big tech players and what they're doing, and then going from there, because I think that's something that even Warren Buffett has done. So
yeah, and someone always says, right, like the sayings goes, whatever he buy, you just follow. Probably
Yeah.
And I think you brought out a very good point. Consumerism, as long as you believe in it, like I own an iPhone, that means I would believe in Apple generally. Yeah. So if you stay equally invested, whatever you purchase, you can look at that stock,
Yeah, but I would say don't just. People say, oh, invest in what you like, and I don't always agree with that, because I like certain things and some things are terrible companies. So I think it's be mindful of that and make sure that what you're investing in is a good company. It's got solid fundamentals. It generates a lot of cash flow, et cetera, and just be confident in it. Yeah.
Okay, sure. Okay, let's go for the second question. What is the second question? US stocks and ETFs are relatively expensive relative to local ones. How can local retail investors with less means access US stocks at a suitable scale?
Okay. US stocks, ETFs, yeah. I think I would agree there are certain stocks that can be really expensive. So for example, like an Amazon, costs upwards of
$2,000.
But there are also other stocks. There's, plenty of great stocks that maybe cost maybe 100, 200. For example, Apple's in the hundreds, Microsoft's in 250, 260. Yeah. I think they are expensive for a reason. I hate to use that cliche, but they are companies that will grow and compound a lot, I believe, a lot faster than anything locally, just because the local, again, if you go back to that slide about Netflix, it's just that company has global reach, right? So if you think about a Singapore company, that has global reach. There's really nothing that has global reach as a Singapore company. And so the same goes for even from where I'm from in Hong Kong, like all the biggest companies in Hong Kong from China. So they're not actually even from Hong Kong. All the, sort of big Hong Kong companies they're like tiddlers, they're tiny, right? And the returns have really spoken to that as well. The returns have been bad. So I think it's just a case of these companies just operating in too tiny a market, too small a market, and not being able to expand beyond that and be world beating. So I think when you've got world beating companies in the US, and then you've got some great world beating companies in China as well, just because of the size, that's where I believe that most of the returns will be coming from. And so they are expensive for that exact reason.
I find it really expensive to buy an Amazon share, to be very frank.
It is. Yeah, it is. But there are plenty of other great options, ETF options, which maybe aren't in the hundreds of dollars, which track specific US sectors or markets. Yeah.
That's right. Okay, next question. We have US stocks are currently buoyed by high liquidity and fiscal stimulus. Are the US markets now too expensive to enter?
This is something that's really created a lot of debate. Obviously liquidity, and then with fiscal stimulus, and I think the Warren Buffett indicator of market cap to GDP. So there are lots of data points that you can use and point towards saying this is expensive, this is not expensive. And I personally think at this point in time, with some of the larger tech names, if you're thinking about the big tech names, the amount of cash that they throw off, I don't think they're trading at insane valuations like they were maybe in 2000. If you look at some of the run-ups pre-2000, some of the largest cap companies were going up like 2,000-3,000% in like 2-3 years, right? Which is insane. But if you're looking at sort of Microsoft or an Apple, maybe they have doubled over the past maybe 2-3 years. It's not, I don't think, in bubble territory or crazy. But this is always something that we are afraid, right? It's always that taking that step, oh, is it too expensive? Is it too expensive? And then it goes up. I think it's just good to remember that if you are scared about the timing, I mean, everyone has that emotion of it's too expensive. I think it's just best to think about putting money into the market on a regular basis and just doing it as a regular habit. I think the best way I can describe it is make it a habit to just put money in every month, or when you get paid, put aside like however much, like however many hundred or however many, whatever you want to put aside, just put it aside and then put it into the market on maybe the same day, or split it up and do it, once every quarter. But I think just getting that habit forming is good, because when it does come down, because inevitably it will come down, that's when you will continue to buy, right? But on the whole, markets go up over the long term. And I think but the scary thing is when they fall very sharply. But when they go up like super slow. So
I think during the COVID situation in US, we can see that markets actually were very turbulent. And it dropped way beyond for certain counters, right? Like retail got hit really badly.
Yeah.
So I think I agree with you on the dollar cost averaging methodology.
It kind of takes that whole like apprehension out of the equation, and I think that's a good thing for a habit of like investing. I think that's a good.
That's correct. Okay, the next question. We are running out of time, and there's so many questions this evening. Okay, there are dual listed counters or stocks that are listed in both US and Hong Kong exchanges. What are your views and opinions for investors when they are deciding which exchange to go into?
Okay. I think there are important considerations for each. I think for younger investors, and if you want to access really liquid stocks and really and you don't have to pay a lot, I think US is like the default, just because it's so easy to access. So even Alibaba, I think the majority of its float, which is the amount of shares, the majority of it is actually traded in the US. But Hong Kong is becoming bigger because that's where a lot of the institutions are starting to trade their shares, is in Hong Kong, because they're hedging that geopolitical sort of friction. I think Hong Kong has got high barriers for a lot of younger investors, just because of the pricing. I think it's expensive to buy a lot. Sometimes it can be a bit expensive, but if you're looking at some of the big tech names, some of them can have reasonable lots, and that's fine. And Hong Kong will provide that liquidity as well. But if you're looking at something that's easy to go in and out of and with maybe lower threshold, I think the US is still the best place to do that.
Absolutely. And I think Hong Kong has a minimum lot size based on the counters. So
yeah, and that
so it will increase the barrier of entry, is what you mentioned.
Exactly.
Yeah.
Exactly. Yeah.
Oh, cool. I think we have another couple more, and we have less than 2 minutes. Let's go.
Go for it.
Okay, psychology-wise, how does one overcome inertia and hesitancy when it comes to buying stocks?
Yeah, I think this is what I've gone back to with the psychology of investing. I think a lot of the actual success and downfall of people is just behind the psychology of it, is just not taking the action or taking the action or doing something wrong and you're scared to do something. But I think, as I said, I think just finding really great companies to invest in, or if you don't want to do that, and if you don't want to think about owning a stock, or if you are a bit more wary of that, then finding an ETF that you're comfortable investing in, then just put that, as I said, aside every month and just get into a habit. Because ever since I think I was younger, I thought about saving and investing as different things. So saving is actually saving your cash. And then investing is putting a portion of that cash that you're saving every month into the market, into investing over the longer term. So I think overcoming the inertia is just, you just need to be comfortable with the fact that the stock market can go up and down. But if you leave your cash in the bank, it will definitely go down over time. So I think overcoming the inertia is knowing that if you put it in the market, you have a fighting chance and a very good chance of making money over the long term. So I think that's how I think about it, is if you leave it in the bank in cash, you will definitely 100% lose money, because inflation will eat away at your money. So there's no point in leaving it there. So I think
I have to agree with you on that, especially when you look at a particular counter and you're just hoping that it will hit that price, right? So you are always hesitant. So what I was always
and this always happens to me when I buy a share as well. It's like, immediately, like 2 days later, it like falls, and you're like, oh, that's
right. So you can deploy methods like putting a limit order, like so that
don't think about it in terms of days and weeks. Think about it in terms of years. That's how I try and think about it, because over years, if you put your money in, is 3 or 4% going to make a difference in like 10 years? Probably not.
That's right.
Into the right stocks, in the right ETF, even the ETFs, it won't make a big difference to your returns over the long term. So it's more about being okay with it, being psychologically okay with, the stock might fall like 5% or whatever, and then the following week that you buy it, right? That's just, that happens. I feel like that happens every time. It feels like every time that happens, like every time maybe I buy a stock, it feels as though it falls the following week, or it might rise. So
they share the same sentiments as you.
Yeah, I think just get into a habit, be okay with it, but think about your returns over years and not days and weeks and even months, because that's not the right way to think about it.
Yep. So I think let's take one more question and we can round up for the evening.
Sure.
And we will answer those questions that are unanswered either in our following sessions, or we will post them in your messaging.
I'm happy to do a few more if we have time. If there are a couple others coming through, let me know.
Sure. Let's see what's the next question. Is ESG stocks really worth to look at? Sustainability.
Okay, sustainability. Okay, so this is environmental sustainable governance. It's environmental social governance. I think, that's a term that's really sort of bandied about a lot, and there's really no, a lot of people say, I'm an ESG fund, and it's actually someone from BlackRock, who is an ex-BlackRock CIO, wrote about this recently, just talking about companies or fund managers that talk about, they basically have a portfolio, and over the past year, they've just changed the name into, this is an ESG fund, but the components of that portfolio, the stocks inside it, have pretty much remained the same. They're exactly the same, and they're not ESG friendly stocks. So there's a lot of marketing spin, I think, in the financial world as to what is ESG, and I think you need to be really careful about what you're buying or what you're buying and thinking is ESG, because a lot of the time it may not actually be ESG. I guess that's one reason why I like to pick my own stocks, is I think about the impact of that company and what it's doing, and maybe what its sustainability policies are, and they'll be a bit more sort of vocal about that and communicate that with shareholders. But obviously that takes time to understand that as a shareholder. I think it's worth looking at these companies in renewable energy. I think it's worth looking at these companies in electric vehicles. It's just, I think when you're thinking about funds and even companies, there's a lot of greenwashing. They call this greenwashing, where they just say, I'm doing this, I'm doing that, and I've got these goals, but do they really do stuff? That's something that people need to be to be wary of and to monitor as well, whether they're living up to their promises. Yeah.
Great. I think there is one more on the pipeline.
Okay,
I'm
cool.
seeing from our Q&A session. Do we have it ready? Or okay, yes, we do. Okay, how many stocks do you recommend we have in our portfolio? Good question.
Okay.
I also want to know that.
So this is a question that I think a lot of people get, and I think I'll give my own opinion now, and actually also in the how to build your portfolio. I think for anyone who wants maybe a truly diversified one or minimum diversified one, I'd say, like say 15 to 20 is a good base to start at. But I know people that have like 10. So I think it also depends on your risk tolerance level and how happy you are to hold, 100% of your, or like maybe 10% or 15% of your total net worth in one stock. It's your comfort level. So I think for people who are starting to build a portfolio, I think, just try to get to sort of 8 to 10 to start with, and think about companies you really like, and then try and build it from there. But I think once you get past sort of like 40 or 50, it's just like too much. I think it's just too many companies to track. So I'd say ideally you kind of want maybe like 20 to 30. But starting out, if you're starting out at 0, I think just try and build positions in 5 to 10 first, and then think about expanding it over time. Because if you're young, you have the time to build that portfolio out. So I think it's totally dependent on your stage of your life and how old you are and what your goals are as well. So I think I'm reticent to kind of just give a cookie cutter answer, because it will be different for everybody. But I'd say on a general basis, yeah, I'd say sort of like 15 to 20 would be a good gauge.
Great. I still have a long way to build it to 15 to 20. All right. I think tonight we are at the end of the Q&A session.
Okay.
Just to refresh everyone's memory, I'll give away for those who are signing up for the new accounts. Remember the promo code T for all, and also do complete the post-session survey. And yep, we'll hear from everyone. So have a good evening, and thank you very much.
Thanks, guys. Thanks.
Thanks.
Take care. Bye.
Bye.
Bye.